God. Good morning, everyone. We will get started in about 5 minutes, 3 to 5 minutes. We're going to give an opportunity for others to join. So we'll get started in about 3 to 5 minutes. So if you could please put your name.
Olga, can you hear me?
Yes, yes. Can you hear me? So if you could please put your name, company name, and city in the chat. Good morning, everyone. We're going to go ahead and get started. Can everybody hear me? Can you confirm that you can hear me, Rob?
Hey, Olga, can you hear me?
Yes.
Oh, perfect.
Okay, we're going to go ahead and get started. So today we are going to, our host for today is Robert Hatter, and he's president and owner of Nationwide Credit Solutions, Inc. He'll be taking care of the presentation today on credit, on personal credit and business credit. So we're going to go over the housekeeping. So please make sure you mute yourself and keep your video off. If you have any questions, make sure you enter all the questions in the Q&A, not in the chat. We will answer the questions through the presentation. So we'll pause every now and then to make sure we answer all those questions timely. This session is being recorded and it'll be provided to the firms with a follow-up email with along with other resources if available. And then there also may be a short survey following the presentation. So please let us know how we can improve, and then let us know if there's any ideas for future workshops. Today's agenda. So today we already went through the introduction and housekeeping. We're going to go over IDOT's goals, supportive services, and resources. We're going to go ahead and get started with going over personal credit. After the personal credit, we will be going over building business credit. And we will end with questions and closing remarks. IDOT's goal. IDOT's goal is to provide assistance to DBE firms and individuals interested in business with the department in ways that ensure equity, access, and transparency. IDOT, in accordance with federal guidelines, strives to facilitate and implement programs that can help current and future business partners open the door to doing business with IDOT. The department works towards this goal in a variety of ways, most notably through the tools available at our resource centers. The supportive services program that is executed through our partnerships with consultants who provide management and technical supportive services assistance, and corresponding supportive services programs that fall under the umbrella of supportive services program. This support is provided at no charge to IDOT's DBE firms, to firms seeking IDOT DBE certification, to Illinois UCP DBE certified firms who have an IDOT contract, and to prime contractors doing business with IDOT. So the Office of Business and Work Diversity is the contact there is Mr. Brian Hendricks. His email is there if you need to get a hold of him, and he is the Policy and Supportive Services Unit Manager. So learn and grow with supportive services. While opportunities may increase for certified DBEs, it is not guaranteed. Free programs and resources support firms' goals at all phases of growth. You will develop technical and management skills, navigate operational expenses, connect with established firms, discover best practices for successful work with IDOT. You can visit idotillinois.gov to find your nearest resource center. So with the resource centers, each of IDOT's 9 districts offer essential equipment and resources to conduct business with the agency. There is computer access, internet, scanner, copier, printer, staff assistance, including support for DBE applicants, These resource centers are free of charge to all firms seeking to do business with IDOT. Visit again idot.illinois.gov for a list of locations. And here we have a list of locations. So District 1, there's a couple of resource centers, one in Chicago and one in Park Forest. District 2, we have one, there's a resource center in Dixon, Illinois. District 3 in Ottawa, Illinois. District 4, Peoria. District 5, Paris, Illinois. District 6, Springfield, Illinois. District 7, Effingham. District 8, East St. Louis, Illinois, and District 9, Carbondale. So these are also on the website if needed. Technical and management assistance. Ongoing assistance helps DBEs maintain a competitive edge. So some of the services that are provided by IDOT, consultants through IDOT, is estimation and bidding, financing, accounting systems, business plan, and much more. This assistance is complementary to IDOT's DBE firms or firms certified in that Illinois UCP that are bidding on IDOT contracts. So here's a list of the supportive services consultants by district. So if you're looking for certification through for District 1 through 3, Theo Joyner. District 4 through 6, Melissa Hamilton from Synergetic Solutions. District 7 through 9, Mark Vaughn from FV Consulting LLC, and they handle certification in those districts. Management Services, District 1 through 3, Michelle Ringgold from Ringgold Financial. District 4 through 6, Melissa Hamilton from Synergetic Solutions. District 7 through 9, Mark Vaughn from FV Consulting. And the technical services, David Clark from ESI Consultants. And he's responsible for District 1 through 9.
Welcome to WebEx. Enter your access code or meeting number followed by pound.
If you please mute yourself. Okay. So workshop and events. The Borough of Small Business Enterprises brings innovative events to the public with three goals in mind. Share skills to become more competitive on IDOT projects, help individuals and businesses work with IDOT and form strategic partnerships, encourage sharing of best practices, policy and procedure changes. Each district hosts events year-round to help firms do their best work with IDOT. And down below, there is the bit.ly link where you can sign up for the workshops, and it'll give you the workshops that are coming up, and you can sign up there. And these are all free. So today's challenge, tomorrow's reward, TCTR. So our next TCTR is scheduled for February 15th and 16th, 2023. So please save the date. IDOT's TCTR conference provides opportunities for networking, skill building, and knowledge sharing among our vendor network. All firms doing business with department, including primes and subcontractors, consultants and suppliers, and our various partners are welcome. So if you have any questions, you can go ahead and give a call to 217-782-5490. And the available programs. So they have the DBE reimbursement program. IDOT offers 50% reimbursement to qualifying firms in select categories while funds are available. So they give reimbursement on association, organization membership cost, training or certification class, website capability statement capability statement and logo. And you can contact the Borough of Small Business Enterprises to discuss criteria for these limited time funds. The Business Development Program, qualifying DBEs can receive firm-specific guidance to propel their growth in the transportation industry. Full business evaluation and analysis, tailored training that may be eligible for reimbursement, personalized recommendations to maintain competitiveness. Enrollment opens once per year. 15 firms are accepted annually, and applications for 2023 will be open soon. You can visit idot.illinois.gov for more details. mobilization payments. To account for the preparatory work and operations necessary for the movement of subcontractor personnel, equipment, supplies, and incidentals to the project site, and all other work or operations that must be performed or cost incurred when beginning work, the contractor shall make a mobilization payment to each subcontractor. The mobilization payment must be made at least 7 days prior to subcontractor starting work. The mobilization payment to the subcontractor is an advance payment of the reported amount of the subcontract and is not a payment in addition to the amount of the subcontract. Therefore, the amount of the advance payment will be deducted from future progress payments. The amount paid is a percentage of the value of the subcontract shown in the table below. Okay. HCCTP program, the Highway Construction Careers Training Program, boosts participation of diverse individuals in the industry and IDOT's highway construction projects. Illinois Community College partners offer training in industry, trade, and life skills. They offer OSHA 10 certification, welding, forklift operation, first aid, CPR, AED, math for the trades, introduction to electrical, plumbing, sheet metal, carpentry, introduction to tools, and much more. Employment is not guaranteed. However, participants do receive job placement assistance. So with that, you 4 reasons why HCCTP graduates make ideal hires. They're well trained to fulfill entry-level roles, professional talent with diverse perspectives, eligible for work on IDOT project sites, reimbursement via IDOT training special provisions. Okay, so we're going to go ahead and get started. Just a reminder, please remember to enter your questions in the Q&A box and make sure you're muted and your camera's off. And with that, we're going to go ahead and have Mr. Robert Hatter start with today's meeting.
Can everybody hear me?
There's an echo, Rob.
I'm sorry?
There's an echo.
Okay, how about now? Can you guys hear me?
There's an echo. Are you
I
using?
know I'm having a problem hearing you, but I called in. So let me see if I can.
You're going to have
Can
to
you hear
mute.
me now or no?
I can hear you.
Okay. So I'm sorry, I'm having some technical difficulty here, but thank you for introduction. Do you want me to get started or?
Yes, you can, but if you'd like to mute either your computer or your cell, if you called in, it's causing an echo. There we go. I think.
That's better? Okay.
Yes, that's better.
Okay, I'm sorry. I know this is going to be echoey. I don't know how to fix it right now.
Okay, we're going to go ahead and get started. I'm going to go ahead and mute myself.
Okay, and again, everybody, I apologize for this technical difficulty, but my name is Rob Hatter. I am the owner of Nationwide Credit Solutions. I've done this a couple of times already. I'm a credit expert. I'd like to call myself. I've been in the credit repair industry for over 10 years. My background on myself, I was a realtor for a while. I was a mortgage broker for over 20 years. And the last 10 is owner of Nationwide Credit Solutions. So I've been, most of my life, I've been in this finance credit industry. I like to go over a couple things with you, to go over how personal credit works and business credit works. I think we're going to start out with the personal credit. I think we have a slide up, so let's get that started. Just so people know, and I'm going to start with the basic credit 101. If a lot of you guys know about this stuff, I apologize, but if you have questions, I can get in more detail. But so you know, anytime you apply for anything, for a credit card, for any kind of loan, for a mortgage, people are going to pull your credit, and that's called a hard inquiry. That shows up on your credit report that someone pulled your credit because you applied to get some kind of finance from them. And if your scores are low, obviously you can't get approved. So a lot of people don't go out of their way to find out what their credit is before they apply for something. They always find out when they get denied. And I always recommend people always to look at their credit beforehand to see what's going on, what they can do, why their score is low, because that's obviously if it's low, you're gonna get approved, and that's going to be a negative derogatory on your credit for an inquiry. So that's something I recommend to everybody. Always look at your credit before you apply for something. Next slide. What is a credit score? How that works? But people always just, they know that's what their credit score, but they don't know how the score becomes a score. There's a lot of things that go in a factor each month on your credit that accumulates to that score, whatever that is. I know a lot of you heard of it, FICO score. It's a three-digit code that these companies give you, and that determines your risk ability to get a credit or not. There's a lot of factors that go in it. I'm trying to explain the basics, how the score becomes a score, and what you can do to help yourself to get the better score each month. So next slide, please. Okay, so I'm looking at this as from a lender aspect. Uh, every time you apply for something, the lender is going to look at you as a risk, or or the bank's going to look at you as a risk. If how high risk you are or low risk you are, the higher risk you are, obviously, the chances of you getting turned down is greater. Or if you do get approved, the chances are going to be a higher interest rate than you're used to. If you're low risk to them, they're obviously, you fit in with their guideline, they'll be able to give you the loan and also a better interest rate. So that's how banks determine every candidate that applies for a loan. If you're high risk or low risk is better, obviously, for them to give you the money. If it's a high risk, the chance of getting turned down is probably greater than getting approved. And again, if you do get approved, it's going to be a higher interest rate, higher terms. So I want to get that out of the way. Next slide, please. Who creates that credit score? How it came about? Like if you go back like 35, 40 years ago, there was no such thing as a credit score. It just let an underwriter looked at your everything, make sure you qualify, and you'll be able to, give you a loan or not. There's a company called FICO. I'm sure a lot of people heard of them, and it's called Fair Isaac Company. That's the abbreviation for FICO. They started gathering data, for companies for their clients to see how risk worthy they are to them, and they generated a score to it that all these companies and especially banks will go off of that model to create a score to figure out how high risk or low risk you are. So that information is just basically your history of your credit, how you make your payments, if you have any late, your debt to income ratio, all those things on the credit, that all factors into a three-digit score that really these lenders look at and see if they qualify you within a certain bucket of rates that they have. So that is how that's determined, and all these companies, especially mortgage companies, bank, are adapted that analysis. So their underwriting models are equal with the FICO score is, so they can get you whatever approval you're trying to ask for. So that is where that score comes in, the FICO score. And next slide. There's three companies that gather all this information and these lenders use for their scoring model to approve you for loans. I'm sure you guys heard of all of them. It's called Equifax, TransUnion, Experian. Those are three separate companies. They don't work together. They just gather information. Again, how your pay histories have been in the past, what your loan values are, how much credit you have, and so on, to come up with a credit score that these lenders can use. Every lender is different. They use different companies. Let me start with the mortgage companies and banks. When you apply for a mortgage, banks pull all three bureaus, and they use the middle score of the three to qualify you for any mortgage you're trying to do. And that's across the board with all lenders. And that's on the mortgage side. But if you go, for example, you buy a car, a credit card, or so on, or a personal loan, some of them may just use one of these bureaus to qualify you for their loan, but they don't tell you which one it is. I've heard lenders like rotate within every couple of years, use a different company. But those are the three that's been used. So you always want to make sure your score is high as possible in all three, because you're not sure who the lender is going to be using to qualify for a loan you're applying. So those are the three companies that everybody uses: Equifax, TransUnion, and Experian. They look at those histories, what they have on file to determine your credit score. Next slide, please. The scores are range. They range from 300 to 850. Obviously, 850 is the highest, and there's not a lot of people that have that. But and 300 is the lowest. Obviously, you don't want to be in that bracket. Uh, the scoring range it depends what what it is right now. Because a few years ago, the scoring of like 680 middle score, that was considered decent. But when the last 5 years or so, that kind of they increased that to about 720 plus. So how you determine those scores again is based on your history on your credit, how you make your payments, how much that you control, that determines that score. So anytime you apply for something, you always want to have a score of 680 and above. These days, 700 plus. You're gonna get the best rates out there. Obviously, the higher the better, but this kind of gives you the scale what lenders look at and how the scoring model work. Again, 300 is the lowest. You do not want to be in there. You want to be in the seven, in the B to A bars over here, because that gives you the best options possible. Next slide, please. What determines good credit? Like as we discussed before, creditors look at you as a risk when you borrow money. How are you going to repay them back? The higher the risk, the higher the interest rate they're going to give you, and the chance of getting turned down is low. The lower the risk, obviously, is better, because the chances of them getting their money back is going to be higher and greater. So they're going to give you the lowest interest rate. So that's always got to think of that in the back of your mind when you apply. That's why I want to reiterate what I said before. Before you apply for something, just take a look at your credit report, see what the score is. Please do not look at your credit karmas and stuff and or your credit apps from the credit card companies you get, because those are different scoring models. They're always going to be different than what the FICO score is pulled. And again, I'm reiterating on banks what they look at right now. As far as like mortgages, lines of credit, and so on, they look at the FICO score. So you need to develop a high score there, and it's all controlled by a few things that I'm going to go over next. But again, please look at that, because that's a scoring model that they all, they use to qualify for all these financing. Next, slide, please. Okay, this is, Olga, there's a slide behind this one. Is that the chart? Is that we can put them both on one? No, the one, go next slide, please. The one after this, yeah. There's no way you can put those two together. Well, let's start with this one. This is the pie chart I like to show people how the score becomes a score. What are the major factors in it? There's 35% of your pay history counts against your credit score. Obviously, that's common sense. You got to pay your payments on time. But the other factor that's 30% as high is the amount you owe. And that's basically on lines of credit and credit cards that you have. Those two items control 65% of your credit score. Now think about that. You make your payments on time, but if you have credit cards that are always maxed out, you're gonna get a lower score because you're maxed out on a credit card. Lenders like to see you having a good history, making on time, but also have low balances on your cards, because like I said, those two things determine a big chunk of your score each month. So you want to make sure you're in control of it, and I'll go back and I'll emphasize that a little bit more in a later slide. The other thing is the other 10% is new credit. You always want to have a new credit you apply for. I'm not saying go apply all the time, but you need to have a different types of credit. So that determines if you have a lot of people apply in your name, or you applied in your name a lot. If you go car shopping, and so there are a lot of inquiries, 10% of that counts against your credit. So you want to make sure you don't have a lot of inquiries on your credit. The other 15%, which is biggest, linked to credit history. You always want to have, linked to time, preferably over 3 to 5 years on a credit history. So that determines, like, you have experience with credit. You can manage your credit. You can pay it on time. You have the history of it, of making payments back. That controls a portion of your score as well, because they look at that. And the last is a type of credit that you use. That's basically have a right of credit. You want to have like a term loan, which is basically mortgages, car loans, anything you pay back with a certain amount of time is considered a term loan. The other factor, you can get a line of credit or or a credit card. Those are credit that you use and you pay down, you use and you pay down. That factors in back to your amount owed because you're in control of that. Think about you getting a credit card is you have no balance on it. So the more you use it and abuse it, the less your score becomes because you're going to show a pattern of always maxing out your card. They don't like that. Olga, can you go back to the previous slide if you don't mind? Yeah. This kind of explains what I just said about that chart, but I figured that chart is a little bit easier to understand of where everything goes. So the top two are kind of the most important stuff that I always talk to my clients about is paying your credit cards on time and having the balance as low as possible. I understand you can't do that each month. So at least make the minimum payment on there so you can be derogatory and then over time try to pay down some of those cards because that is a huge portion of your credit. And I do have a lot of clients that come to me and they have perfect pay history and everything and their scores are low and they're wondering why. The first thing I look at is utilization. And that is a big factor of your credit. So you can have the perfect pay history, but if you're maxed out on all your credit cards, lines of credit, your score is going to go down. And people don't understand that. And now you know why, because that controls 30% of your credit there by itself. Okay, next slide. The one after that. Okay. Now, how does bad credit affect you? I know that just sounds silly, but low credit hurts you in different ways. It's not just about you getting loans and credit cards. A lot of people pull your credit. If you have car insurance for example, insurance companies do pull your credit. It's a soft pull. You don't see it on your credit history, but they do pull it, and they determine if they can their premium how it's going to be based on your credit score. If you have a high credit score, they're going to give you a lower premium. If you have a low score, they're going to give you a high premium. Your monthly payment's going to increase. Renters also, landlords, management companies also pull your credit to see if they can rent to you or not, because that determines your habits of making payments. And I believe it or not, then they can deny you. Some management companies require a credit score in the mid 700s to rent from them. That's higher than lenders qualify you for a mortgage. So that tells you how important that credit is. And lastly, employment. Anytime you apply for any company, it's got in the finance industry, um, insurance industry, banks, they always look at your credit. They want to make sure you have good credit before they hire you. So I do have a lot of customers that come to me that they want to, work on their credit so they can get employed. So it's not just about when you apply for something. There's more to it than your credit than just, your mortgage rate, your credit card rate. You look at the insurance rates too. If you are paying a high insurance premium right now, and you have to look at your credit. If it's low, then there's a reason why you're paying a high rate. If it is high and you are still paying a high rate, then you got to talk to your insurance agent or find a different company because they all go off of an insurance scoring model when they give you those premiums. Just an FYI here. Next slide. Poor credit again. I'm going to go back to this because we've been seeing more of that lately. Um, it, think about the hundreds of thousands of dollars that you pay over time, especially on a mortgage when you have a high interest rate. People don't determine that. People get fixated by the payment itself, but they don't look at the interest that they pay. So when you have a low credit score, you get a high interest rate to pay on something. The term still could be 5 years, 7 years, to pay something down. But if you look at that, how much of your payment, how much that portion goes towards principal, how much goes interest. Most of it will go towards interest all the time because the lenders want to get their money back, their interest back before you start having anything towards principal. The better rate you have on any term you get, more of the money goes towards principal. So eventually you pay it down quicker. So for the same payment, you can get a term for 5 years instead of 7 years. So you save 2 years of interest, let's say, for example, or even on a mortgage. They give you a 30-year mortgage on these things, but the first 7 to 8 years, you're paying mostly interest. And if you look at the amortization schedule of your payment, you'll see that how much money goes towards principal, how much goes towards interest. And it kind of boggles your mind, like how much interest you pay that you don't even touch the money that you're borrowing till after, you're 7 or 8. So that's why shorter term loans on mortgages, you pay a better interest rate because you have a shorter term to pay it back, but more of your money goes towards principal. And to be able to get those, you want to be having a better score. So anytime, you want to apply for anything for on a mortgage or cars or credit cards or anything like that, please look at your credit first and make sure the score where it should be before you start applying getting turned down. The next slide. Yeah, this is one of my favorite slides, and I'll tell you why. I kind of give you an example between a good credit, bad credit, and this is kind of a little bit older slide, and the scores they're probably higher right now, but I've seen that. I just did a typical auto loan for $10,000 over a 5-year term. The one I know with a 580 score is paying 25% interest rate, and people might think it's high. It's not. I've seen it even higher than that. And the one on the right pays 5% interest rate. Look at the monthly payment. So look at the difference. So the one on the left pays $294 versus $189. It's $105 difference. Over the term of the 5-year, how much the difference the cost? You're paying $6,200 more a month than you or for the life of the loan on interest than you do when you have a score of 90 points different. So that's a lot of money you can be saving. That you can put into a savings account or retirement account or something that can make money for you instead of paying the lender high interest. Or you can get a shorter term on that car. Instead of a 5-year, you can pay it off in 3 years with all that extra money. So this kind of just gives you a gauge of how much you can save by just having a chance to look at credit and improve it a little bit so you can get a better rate. So more of the money that you're paying each month goes towards principal versus an interest. Guys, lenders may have enough money, banks get enough money. They charge that how they make their money is by interest, late fees, and all this stuff. So if you can control this little portion of your credit before you apply for something, look at the difference how much you can save. And that, to me, that's a lot of money. And now these days rates are even higher, so that's probably more savings in your pocket. But this kind of gives you a snapshot of what the comparison would be between having a score of a 90-point different. Even if it's 50-point different, you'll save a lot more money. So, and people say, well, 90 points is a lot to increase. No, it's not. I've had clients improve over 100 points within 30 to 45 days. It just depends what's on your credit, what we can do with it. So that's something really I should take a look at and just think about the numbers. Numbers don't lie. That's a lot of money you'll be saving to a 5-year term. So next slide. And a lot of people I get asked, like, how if someone's got bad credit, with judgments, collections, and so on, how long they stay on their credit. And this is kind of a snapshot. I can tell you this is because every state is kind of different. This is in Illinois, so typically judgment stays from the day of file is 6 years, but it could be up to 10 years on those. I know the state says one thing, but it depends when they file it. And if the person that put you in judgment can extend it. So that usually stays on there about 6 to 10 year span, the hard inquiries, usually 3 years they stay, but anything within 2 years, really, if it doesn't count against your credit that hard, but they still show up on your credit history. Collections, they go about 6 years to 7 years that show from the last activity. You gotta remember that. It's from the last day reported, not from when the collection was open. So I get a lot of people that say, hey, I got a collection 7 years ago, it should be off. As long as they're reporting it each month, that's still gonna be, it's from the last day they stopped reporting is when it falls off. You gotta remember that. And collections company, just to talk about that briefly, if you have a collection, let's say you have a credit card that went to a collections with collection company A, and no resolution happened, and you're thinking they stopped calling, they forgot about it. That collection company have a right to sell it to another collection company for the same debt. So that can go on your credit for a different collection company name with the same debt, and then that 7 years will start over. So that stuff you have to look at with these collections and all these is from the last day of reported, that was last report on the credit, not from the day it was open. The other consumer ones at bankruptcies, they go to 6 or 7 years, but they actually can stay up to 10 years on the actual credit report. But after 5 years, honestly, it doesn't affect your score as much, especially when you go try to apply for mortgages. I know you can do an FHA mortgage after 2 years discharge after their bankruptcy, you know, 5 years conventional. So there's different, you know, scoring models on those. It just depends on what you apply for at the time. Multiple bankruptcies we see because a lot of people go into a 7 or a 13 or 11. 11 is a business one, but we've seen those on there, but those stay for a little bit longer because there's multiple ones on there. So this is kind of a snapshot of how long they stay on your credit, but anything is disputable. Again, let's go to the next slide first before I go into the next thing. I don't know if there's anything else. Um, yeah, and going back to getting a copy of credit report, there's multiple monitoring agencies out there, but you can get a free report by just, you know, mail one, you know, asking for one from each bureau. You can write them, they can send it to you. It may take you a couple of weeks to get, but it's for free. They can give that to you. You can go to Equifax, you know, .com, you know, Experian.com, TransUnion.com, and you can request one. They definitely mail that to you, but that, you know, that take you a couple of weeks to get, and credit can change in a moment. So there's plenty of credit monitoring sites out there that offer that. I have one that I recommend to my customers. They give you all three FICO scores from all three bureaus on one report, and it's only like $1 for the first 7 days, and it's not an inquiry. So you got to remember, anytime you apply to get a copy of your own report, that's not an inquiry on your credit. The only inquiry is when you apply for something, for a loan or a credit card or something. So that's just a good habit to look at it. You can get that once a year for free, or you can go on those monitoring sites and get it. But you should always look at your credit once a month, every 2 months, to make sure what's on there is accurate, what's reported is accurate. Remember, let's go to the next slide first before I go to my last point on personal credit. Yeah, these are laws protect us consumers. You got to remember that. Well, it's the creditors have to be, and the bureau has to be 100% accurate what they put on a credit report. So it could be your debt, it could be reported inaccurately, and that happens a lot. So all these acts that you see in front of you, that Equal Opportunity Act, Fair Credit Reporting Act, those protect us consumers from these lenders the way they report. So any inaccuracies we see on a credit that is not correct, it could be a date, a balance, the way they're reporting, the consistent data reporting. And remember, all three bureaus, they get the same information from the creditor. So they have to input that information the way they get it. So my question is this to you, and think about that. If the three bureaus have to get the same thing and enter the same information, why the scores are always different? It's because of the way they enter that stuff on their report. It could be, you know, a different balance, a different from one bureau to another, or a different, they didn't record 1 month's payment versus the other. That stuff we look at because that stuff has to be consistent according to the guidelines, according to these acts. And again, they have to be 100% accurate what they put on there. And that's very, very important to know. So when you look at a credit, your own credit, you see some stuff that's not on there, it's not accurate. That is something you can question. You have a right to do that. It could be even bankruptcies, judgments, collections, and so on. It doesn't dismiss the debt itself if it is your debt. It removes it from the credit because it's reporting inaccurately. So those are the things that I know about, and I know what we can dispute, what we have to, you know, dispute and remove hopefully from your credit to increase your credit score by following all these guidelines right here that these creditors have to. And if they don't, by law, they have to do it, you know. And I believe that is the last slide for the personal credit. Am I right, Olga? Or yeah. Do you want to go right into this, or you want to have some questions about personal credit first before I move on?
We do have some questions, so we can go over the questions really quick. Okay, so first one, is it good to have a lot of credit cards, loans open with small balances, or does this look negative on your credit?
No, to have open, good trade lines accounts with low balances is great. Uh, you got to look at the limit versus the balance. You always want to keep that under 30%. So the more credit cards you have, it doesn't, it's not going to hurt you. I know the inquiries might, but that's where the age of the credit comes in. So really having a good pay history, good balance is really going to help you out because that spreads out the debt that you have. So if you have one card, you're always maxing that out. that is really not gonna help you debt to income ratio for that 30% because you're always maxed out. But if you have that same debt spread over a few cards, that's gonna help your credit score increase.
Okay, second question. Does the IRS report judgments, liens on your credit, and how does it affect you?
Well, anything that's reported in a judgment format is gonna hurt your score because that shows up on public records, and a lot of these IRS agents, collections, they used to have it report on the credit, but certain laws were in effect the last couple of years that they're not supposed to do that, but I can still see them. But anything negative like that, of course, can affect your score. But we can definitely dispute that and get that removed. It gets removed from the credit report, not the county record, because when it's recorded there as a judgment, for example, the county record is always going to show up as a judgment. So you have to get it paid off, satisfied, or released, so it comes off the public records.
Okay, the third and last question for right now on the debt collections where companies sell debt to other companies. What if it's over 10 years? Does that start over when sold around?
Correct. It gets picked up as a new collection, even though it's an old debt, because they picked it up as of whenever the first collections company sold it to them. So it's the clock starts on that debt.
Okay, that's all. Okay,
That's why they do that all the time, and I see that with judgments right before the judgment, 10 years, the creditor will go in there and get refile the judgment again. So that's another 10 years. So that they happen, especially if they're bigger balances.
Okay, that's all the questions for right now.
That's it for now.
Yes.
Okay, so I can start with the business credit portion of this presentation. We discussed the personal credit, and this is set up for self-employed people. So anybody has got a corporation, LLC with EIN number, they can get business credit. But a lot of the business credit that you get, lenders still look at your personal because you are the owner of the company. You have responsibility to pay your debt. You want to make sure your personal credit is fine. So the first portion of our presentation about personal credit, it's very important because it carries on to your business credit. And I want to go over that with you right now, how to get business credit and what lenders look at when you establish a business, especially brand new business. And it's not just about credit cards, it's about getting lines of credit, loans to enhance your business, finance, autos, equipment, or so on. This is what lenders look at. So let's start the slide. Next slide, please. Okay, what is business credit? And how to obtain business credit. To get a business credit, you have to have an EIN number. That's a tax ID number. That basically, if you have an LLC or if you have a corporation, when you apply for that, they give you EIN number. I think of that EIN number like your social security number for the company. Your personal have a social security number. It gives you all the history about your personal credit. EIN number is the same thing. It pulls up the credit for your business, what's on there to see how your pattern is with the obligation with the business, what kind of credit cards you have, your profile, your scores, and so on. And there also are 3 agencies that score with the credit like they do on the personal side. So, and I'll go over that with you, but that is what that is basically. EIN number is basically, think of it like your social security number for your company. Next slide, please. Yeah, you need to establish, how do you establish strong credit? It's basically getting trade lines in the company name that reports to business credit. So how do you do that? There's different ways you can do it. You can get a credit card, major credit cards report in the business side. You can get unsecured loans. You can have loans without the owner being personally responsible for it, because all those, the pay history reports to the business credit. They never report under your personal if that was structured right from day one. And sometimes, brand new business is hard to get loans because you're just brand new business, but you are able to get credit cards. You can also able to get vendor accounts. If you have a vendor that you use and you get, monthly stuff from them, you can ask them if they report to your business credit, because they can report their pay history to your business credit, because now you have a trade line that's reporting what a good pay history if you can't get a credit card right away. But it's sort of the same concept as your personal would have an revolving accounts reporting, but they have to be reported to your business credit. So it shows up on the business credit when the lender pulls it, not your personal credit. A lot of people, they come to me and they got a business card. It's in their name. It says business credit on there, but it's reported to their personal credit, not the business. It's when they applied for whoever they applied with. A lot of them will go to their bank right away, and that's how they do it. You have to make sure that they report that pay history to your business credit, because why else would you want to get a business card if it's reporting to your personal? You're not going to help your business that way. So make sure you ask those right questions beforehand and make sure who they report to. So at least you get that credit for you using that card on your business. So next slide, please. What's the benefit to have business credit? People just say, well, I don't need it. I have my personal credit. Um, to increase. But if you look at business credit, if you're looking to have a business that's going to grow, and you need to get loans to grow your business, you need to get vehicles in the company name and so on. It depends where you're at in the business. You need to have business credit that's established, and the reason is this: anytime you have a credit in your name, the debt is in your name. So I have a lot of clients that come into me that's got a business credit, but it's all in their name. So all the debt that they have in for the business is on their personal credit. So their personal credit is going to be low because they're maxed out all the time on their cards. And if they miss a payment there, it's going to hurt them on their personal credit as well. So you look at that aspect of it when that score is always low on the personal side, and now you're ready to apply for a business loan, for example, and you can't get approved because your personal credit is low. And the reason it's low is because of all that business that is on your personal credit. It's because from day one, you did not run it right. You want to make sure you keep your business debt on your business name and then have your personal debt in your personal credit. So that does two things. It keeps your debt to income ratio low on your personal credit, so your score can increase, and B, it shows you have a good pay history on your business side, so it can generate a score for you. So when the lenders pull that, they pull a credit and see, hey, he's got a business credit and personal credit. Your chances of getting approved for those finances are much, much greater. So next slide, please. And a lot of people make a mistake how to set up a business. And I got this from a lot of banks I interviewed with. When you set up a business from day one, what they look for, you just cannot have, they look at certain things that you're established business, where you're at and so on. So to start the business building process, you want to understand how to build business credit and how lenders look at that, especially if your goal is to grow the business down the line. And they want you're trying to get some kind of financing for your company, and you want to make sure you do it right from day one. How to build business credit cards, why are they, why should they be in a company name, not your name, and so on. And these slides I'm going to take you through is what lenders are looking at when you establish a new business from the get-go. Next slide, please. Okay, a name of your business. Have a professional name for your business. You can't have it, Bob Jones Company. You can't have. You want to have a professional, something associated with the business. So when they see the name, they kind of know what you do as a business. So I get a lot of people just name anything, but they're doing something else. I mean, if you look at mine as Nationwide Credit Solutions, they know it's about credit. You need to have a name that associates with the company that you do what you're doing, so it kind of relates. And when a lender or anybody just sees the name, they realize, hey, this is what he does, or this is the business he's in. And keep it small and short, people, so they can remember it. And especially the link to the name, you want to keep it short. So especially when you start establishing emails, web addresses and stuff, you want to keep it short so people can remember it. So that's a big factor they look at, name of your company, believe it or not. And next slide. Business address. Lenders don't believe in PO box addresses when it comes to the lending part. They don't want to have a home address. I mean, a lot of people do. That's fine, but they rather have you have like a business address, a brick and mortar for this, sort of thing. If you have an office, they kind of look at that, because these days when you put an address of your company, they do a Google map, they find out where you're at, and so they know in advance where you're at. So this is something to look at. If you can get you know, like a real address, like a brick and mortar place. Some of them have offices that you can use. That is something lenders look at because they know, hey, this is it's a legit business. They have a place that the customer come and see them, and it's an official business address. It's not a PO box or it's not a home address or anything like that. You know, uh, I'm not saying home address is bad, but I'm just telling you what lenders look at when you're applying for loans with them down the line. That's kind of something that they look at. Next slide, please. Choosing an entity, and that's something you have to talk to your accountant about. If you want to do an LLC or a corporation, there are different corporation do it, a C corp, S corp, and that's something that you talk to your accountant about because it all goes how what kind of company you are, the taxes you're going to be paying. But that is something you have to structure from day one, so that way you can report it with the state of Illinois. So to give you the EIN number that we talked about earlier, so now you can start using your business credit. And you actually need that to open up even a checking account. For they always ask you for the article corporation EIN number when you open up a checking account. So that's something you need to do. And I would advise, you know, discussing that with your accountant, which entity you have to use. But you definitely need to have something with EIN number so you can start building up your business credit. You cannot be using your social security number for that. Next question or next slide. I'm sorry. The tax ID number. What is that exactly? You know, when you apply for any business credit, business loans, like I said, your checking account, the first thing you ask for is the EIN number. Again, that is your social security number for your corporation. So that way they can pull up your history on it to make sure what's reported on there, any, you know, any bad credit, good credit judgments, you know, all that's pulled. So they definitely need that, and you actually need that. It's the first thing you do to start building business credit EIN number because that's got to go on the application. So they see that EIN number matches the company name. So when they report that stuff, you get the credited for the payments that you're making. You know. Um, so next slide, please. The telephone services. Lenders also look, make sure you have a phone number. That's not your cell number that you're using. You can always use your cell phone, but what is the name associated with number? I suggest getting, you know, a phone that's not a cell phone or a specific number just for your business. You know, you want to set up a voicemail. You know, it will be professional. When people call you, they can leave a voicemail. That's a professional business voicemail because lenders will call, believe it or not, and see if someone answers, if there's what kind of, you know, message there is. Make sure you mention your business name and stuff because that is really really important. They also look at if you have a fax, you know, fax number. I know a lot of people don't use faxes anymore, but lenders look at that. You can get an e-fax. It's like, you know, like $5 to $7 a month. People still, believe it or not, fax things, but they have that advertised on your business as well. It's a big thing, you know. Yeah, so the lenders again look at that stuff. Again, I have a professional voicemail set up with a number, and like you even do like a Magic Jack type thing. It's a separate phone for your business that you can take basically anywhere, transfer that. But lenders actually look at that because when they Google your name, they want to make sure that number is attached to it, and do not have your cell number as your main number for your business when you advertise. That's a red flag to lenders, and they like to see, you know, the structure of having a you know a phone number, I'm sorry, a fax number, a phone number, a voicemail, all those things. So I know these sound like silly stuff, but the 10 lenders or so I talked to, they all say the same thing. So that's what I'm passing on to you guys. Next slide. Next. A company logo and website. I mean, it's nice to have a company logo that associates with what you do. It's kind of nice. People remember it, but you also people these days look at first thing look at they look at your website, see what you have available. That's how they search you by Google website. They look at will see what you have to offer. So it's nice to have one because again, lenders would look at that, make sure you have a website that what you do on your website. You know, you show something about the company, your services, or how can you provide people help and so on. It doesn't have to be glamorous, but something that identifies with who you are, so that when they do lenders do a research on your company, they have that. And if they don't have a website, because I have a lot of people, believe it or not, get denied of business finance because these things are not together and they have to put that together. So I know it's a little bit costly in the beginning. I mean, you can get a logo, it look cheap, but the website could be not that expensive either, but something that identifies who you are. And when they do a search on you, they can find you. Next slide. Bank services. You have to open up a bank account, and obviously to have a business account, you need the EIN number and so on. So that you have to do. But you also should, uh, you know, check with your bank and see what they can do for you to grow your business. A lot of people go to whoever they've been banking with personally forever. They open up a business account, but they don't actually interview that bank. Some banks will offer credit cards for the business that can help your business grow, and they report to the actual, business credit. Some don't, uh, but that's something you should always look at when you're looking to have a business account, especially if you have a business to grow. Uh, to me, there's no loyalty in banks. Bank with somebody who's going to help you grow your business. There's a lot of them out there. Again, these days nobody goes to the actual physical branch. Everything's done online. But you got to make sure that these banks will help you grow your business by giving you some, credit cards that's in the company name, not a debit card. A lot of people get a debit card and say business name. They think it's a credit card. That does not report to the credit bureaus. That's just you're just using it as a debit card. You need to have an actual credit card that reports to the bureaus on the business side, so it can help you increase that history there. So now when you're trying to grow and get more business, and then you're trying to get financing done and go bigger loan amounts, lenders actually look at that. So if you do that from the beginning, it'll be easier that to grow with that bank instead of midstream to switch banks is kind of a pain because to transfer all the accounts over, it becomes a hassle. It takes forever. So if you do that in the beginning, that will really save you a lot of headache down the line. Next slide. Good credit and business funding. The purpose of building credit, under your EIN number, is to avoid having companies' liability attached to your social security numbers. What that is any business credit that's a liability to your business. Any business debt that's liable to your business, it should go on your business on the business side. You're not inheriting your business debt into your personal, because that's damaging. You're supposed to keep those separate. So that's a good concept from day one to start. The business debt is the business debt. The personal debt is the personal debt. I know in the beginning it's confusing, but when you ask questions and talk to the right banks, and you can always call me for advice or run something by me, I'll answer that for you. It's to separate the two from day one saves you a lot of headaches down the line. Next slide. Um, all loans on the business side have to be personally guaranteed. The reason because you are the owner of the company, you have to be personally guaranteed that debt that you're getting to the bank. But if it's done right, the business loan will be in the business name. It will never show up on your personal credit. The only time it would, if you go default on it, then they'll put that's where the personal guarantee comes in. So that gets transferred over to your personal debt if it goes in collection or whatever, because you're personally guaranteed. But if you do it right and you make your payments on time, that business loan will never go on your personal credit at all. It stays in the business. That's how you build it up. But the only companies that I know that don't personally guarantee anything is just, 10 million plus companies that have great revenues and the business been there a long time, that the company just guarantees that loan. But 9 out of 10 small businesses, they have to personally guarantee that loan, because you are the business owner and you are the owner of that company that you're applying for. Next slide. Business reporting agencies. There's three of them out there. I mean, they keep growing. Originally, there was Dun and Bradstreet. Everybody probably heard of them. But lately, Experian Business and Equifax Business they've been doing it. Lately, I mean the last few years, and a lot of lenders starting to use them. And business credit is looked at differently. Which the next slide, I'll tell you how that they look at it. But those are the three companies that lenders look at. So when you hear a D&B or Dun and Bradstreet, 80% of them report to that, and that's every activity you have on the business side, every payment you make on the business side gets reported there. So when they pull a Dun and Bradstreet number, that's basically your score to see what your score is on the business side, to see what you qualify for anything you're applying for. But those are the major ones that everybody's using. Next slide, please. Okay, the scoring model on the business is a little bit different. Remember I was telling you on the other one, it's 300 to 850. On the business side is similar, but it's a 2-digit number, you know. So go to the next slide. I think I have the scale on that one. No, it's not. Okay, probably the next one. Well, business credit reporting agencies, they have to approve, you know, to be reported on, with those 3 major bureaus, and most of them are, you know. You can ask any vendor that you use if they report to Dun & Bradstreet, Equifax, or Experian business credit, and a lot of them do. To build a good history of your business credit, you need at least like 5 trade lines. That means 5 companies reported to your credit. It could be credit cards, loans, vendors, but you need to have at least 5 things reported because to generate that credit, the business credit score that we're talking about, you know. So that's a good thing to have. Always ask your vendors if they report, because a lot of them will, but you have to ask them. And by doing that, I mean, a lot of people want a COD. You know, when you get an invoice, you want to pay it right away. But a lot of them will give you a net 30. Net 30, they'll give you time to pay it. It's called, so when you make that payment gets reported to the business credit. So that's something you can ask your vendor about, because a lot of them will do it. And if you don't ask, they're not going to mention it to you. So that's something to consider. Next slide. Dun & Bradstreet, Experian Business, and Equifax. Those are the 3 major ones that report to the business credit. Your business score calculated differently than your personal, which I'll go in a factor, is basically how you make payments back. You know, Olga, can I see the next slide real quick before I go into this? I'm going to see if that's it. Okay, here we go. Okay, this is the scale of business credit. It starts from 0 to 100. Remember, the personal was 300 to 850. This is based from 0 to 100. So if you look at this bracket, you want to be in the 80 to 100% or to 100 points. That's your Paydex score. That's like your FICO score on the business side, you know. That means you have like 720 plus personal credit on the business side, you know. So you want to be in that. And basically, I did look at, if you ever, I don't know if anybody's seen a copy of a business credit. On a personal side, they show you how much you owe, what your balances are, and all those things in the pay history. On a business side, they don't. They look at you basically as how you make your payments back on these invoices. So if you get invoiced and if you pay it within the first 7 to 10 days, and you pay it on time always, 9 out of 10 times your score is going to be between 80 or 100. It's all about the payments back. So if you pay it 2 weeks later, it falls into that yellow, you know, between 50 to 70, and anything beyond that, it gets in the red, which is low. So you're always going to have a practice habit of making your business invoices paid early or paid within this first 7 to 10 days you get, because that keeps your score high. And that's what they look at. They look at the cash flow of the company, the cash flow of the business, how it makes payments back, and that's how they determine your score on the business side. So it's always how you make the payments back versus, you know, paying it 30 days later or whatever, because that hurts it. You know, anytime you have a late scores on your business, it's more harsher on your credit than the personal side, you know, because you have limited accounts on your business versus the personal. So that's the scale you look at. You always want to be in the 80 points plus. That means you have, you know, really good credit. And when they see that, and a good personal credit on your personal credit score as well, that's going to give you a chance to get approved a lot greater than not. Next slide. Again, go back to vendor accounts. If you cannot get credit accounts or credit cards right away, ask the vendors that you work with. A lot of them will report. And again, the idea is just to have 5 vendors reporting on your credit. That's to get everything started. Obviously, the more the better, but 5 is plenty. Trust me. Even 3 is good, but I like to be in between, you know, the 3 to 5 trade lines, because that really gives you versatility with the credit. It spreads out your debt as well. And the businesses that report there, you can have always a higher score than a business to have 1 or 2 accounts reported. You know, always. You know. You always want to make your payments, again, to recap, within the first 7 days if possible. If you can do that, that is great. You keep in that upper bracket. but try not to go past the 2 weeks because again, if you're trying to build credit, I know they can't report you late till it's 30 days, but to get that high score on the business side, you want to make sure those payments are paid right away. Even the minimum payment doesn't have to be in full as long as the pay history is showing that's what they're looking at. And always make sure your company name is correct on those invoices because you got to make sure it's reported correctly to the credit agencies. If it's the name is wrong, then it's be reported wrong. So always double check those. Those are the little stuff that people overlook, but you want to make sure that you're making payments on time. You're trying to build credit. Make sure it's reported correctly. Next slide. Revolving accounts sounds great. I mean, you really need that. Any business should always have either credit card or a line of credit for the business to use because most businesses don't survive is because not because of work ethic or there's no business, it's because of cash flow, and cash flow is a big key. So you always to establish good credit and be able to get a line of credit from a bank that can help you grow your business and have access to money if you need to purchase something that's available. That's huge because that takes you to the next level of your business when you have access to cash and really to build a foundation of business credit that will help you get to that next level of your business if you're looking to grow it. Again, it all goes back to what kind of business you have, but to avoid having headaches down the line, if you establish that strong foundation of business and business credit and trade lines, you'll be able to get those lines of credit cards, even if you don't need them. I would just try to apply to get them anyway, because you never know. Usually when you need a loan, you apply, banks say no, but if you don't need it, and miraculously they approve you. So that's something you have to look at, and it depends the business you're at. If you need help with lenders that can help you grow your business, I work with a few of them. I can definitely refer some to you. So next slide. I think that was it on my side. So if you have any questions on the business side.
I believe we do have some questions. We have one, so we can go ahead and answer that.
Okay.
On the debt collections, where companies sell debt to other companies, what if it's over 10 years? Does that start over when sold? Or, I'm sorry, there's no questions.
Oh, okay. But anything on the business side with credit? I know that's kind of confusing, and I'm kind of giving you a snapshot of everything. It's a lot more to it, but I hope I kind of clarified the difference between the business and the personal. That was the whole idea of the seminar today.
Can I ask a question? This is really rich and insightful. Is there an opportunity to be able to ask some specific questions that are unique to our business, to you concerning the DNB and how we can perhaps optimally position ourselves to build our business credit? Because I see on like Instagram, they have all these you can open up business lines of credit by doing X, Y, and Z, by going with certain banks and blah blah blah. I'd be interested in kind of hearing your perspective on the legitimacy of some of the things that they're representing or the accuracy of them. Thank you.
No, absolutely. Olga can send you my personal email and phone number. If you want to call me, we can do a one-on-one session. There's a lot of stuff that I see like that. There's a lot of companies out there they call factoring companies. I don't know if you even guys heard of that, but what they do is they take your bank statements, they see your average deposits, and they give you a loan based on those average deposits per month. It's always a percentage. But the problem with those, you have to pay those back like on a daily basis or a weekly basis. So they're kind of short-term loans. The problem is when you end up adding the interest on that, you're paying almost close to 35 to 40% of what you're borrowing. It's crazy. And most people fall into that trap because it's easy access to money. The problem, they pay out so much out that their cash flow is going to run out right away. So they deposit the money in your account. The next business, they start taking money out for you right away. So, the short term is good, but the long term, you're damaging your business. And I would love to, to talk to anybody about that just to make sure to understand the difference between factoring and between a regular loan. There's a big difference in those companies, and you see those advertised all the time. We'll give you quick business in 24 hours, 48 hours. There's a catch to that, you guys. There's no such thing as a good loan in 24 hours. It doesn't happen. So you be look at the terms, read them carefully. If you don't understand them, ask questions. Don't just sign stuff away, because once you sign those documents, you're committed. You can't get out of that loan.
We have one question in the Q&A. Is there a way to sort of figure out how much a business can qualify for a loan?
Absolutely, yeah. There's different things that they look at. It depends how long you've been in business. If you're in business over 2 years, usually they can take up 2 years of your average tax returns, and they give you a percentage of your gross revenues coming in, not your net, your gross. So that's a formula that most lenders use. But I work with different lenders that do different things. But just a formula, it's a percentage of what gross income comes in on the business, and that you should qualify for that on either a line of credit or a credit card or both, And that's something I can help with as well if someone have a specific question, and I can, because every business is detailed differently, so we can get more involved on a one-on-one with that if they need to.
Okay, perfect. We're gonna, if there's not any questions, we're gonna go ahead and move on. This is just a slide of the upcoming workshops. We do have winter workshop series that have started already in November they're through March, and they're usually Tuesdays and Thursdays from 10 a.m. to 12 p.m. So remember to register here on Bitly DBE workshops. And then you can follow them for future updates. This is a flyer of what's coming up. And some of our upcoming events are Prime Meet and Greets. We have one December 7th for District 6 in January 2023. We do have Prime Meet and Greet from District 4 and District 1. The dates are to be determined, and we have TCTR February 15th through the 16th, 2023. So make sure you subscribe to the Eventbrite page to get all the news and the information of when we'll have workshops or whatnot. So thank you for attending. If they send you a survey, please make sure to send us feedback on today's workshop and on any ideas for any future workshops. And you will also receive an email with the recording of the event, presentation, and then if there's links or resources, any upcoming workshop and events, and then you can contact OBWD staff, consultants, and contract compliance officers. And you can contact the Borough Small Business Enterprises. For more information, I'm going to go ahead and put my information in the chat along with Rob's information. So if you have any questions, feel free to reach out to me or Rob. And with that, I think it concludes today's meeting.
Hey guys, thank you.